Van, you'll have to come.
So I'm
I
gonna
will.
tomorrow at 12 o'clock, we will talk about Seattle and San Francisco.
Okay.
And for now, we're gonna talk about the global markets. Stephen Burke, are you ready?
I'm good.
Okay.
Think.
You think? What? Wojciech, are you there? I thought I'd just ask about the Polish election, but
Go right ahead, Mark. Wait.
well, I sort of did, but he didn't answer. It's all good. So 269, briefing 269, Stephen Burke.
That's it.
That's it.
All righty. Get this out of the way and good to go. So we've had quite a 2 months this quarter to get started, but I used to work with somebody who was the chief investment officer, used to say today is the hardest day to invest. And I think that's been true for the last 2 months. We've seen the tariff turmoil really disrupt the global economy in ways that people hadn't quite imagined and still haven't quite figured out the implications of. But you're starting to see how people are viewing what the future is, with the OECD lowering their global growth estimates to 2.9% for this year and next, down from 3.1%. They lowered the US from 2.8% down to 1.6 GDP growth this year and 1.5 next year, and they're not expecting any Fed cuts as a result. They took China down from 5% to 4.7 for this year, 4.3 for next year. They have the Eurozone around 1% this year growth and 1.2 next year. Japan struggling to get to 1.7 and 1.4 for next year. So we're going to take a look at the world, the markets and policy and how it's all coming together. We started the month with trade uncertainty quite elevated, and you can see from the chart it has come down, but still remains at historic levels. A lot of this is due to the tariff and the tariff uncertainty and the unpredictability of President Trump and his policies. We have now 3 new acronyms. One I butchered last week, which is TACO, which stands for Trump Always Chickens Out. That was followed by TALO, which is Trump Always Lashes Out, which happens after he gets criticized for chickening out. And then you have ABUSA, which is anywhere but the USA. I think that they're all interesting, but I think they're just for show. I would say that in the world we're in today, you want to actually maintain your exposure to the US, but start to take advantage of broader diversification and opportunities elsewhere, but not go too far afield too fast and get caught up in the whipsaw that's going on in the markets today. But through all the challenges we've had in the last month and even in the last year, the markets have climbed the wall of worry. And even in the last month, the MSCI World Index is up over 4%. Sorry. Boy, this is going. So you can see that they are moving past the challenges that exist in the markets. And the Europe has been the standout. And I think Anthony Gordon's been highlighting this. I think he thinks I've been negative on Europe. I am negative on the fundamentals of the economies of Europe. I am positive on some of the steps they're taking, particularly with Germany's fiscal reform. But I remain skeptical that the union will get the benefits of its size when they're still acting as 27 different legal systems and 27 different mini economies. Do they get the scale that should come from it? And that's my concern. Not that the potential's not there, but realizing the potential, I think, is going to be more of a challenge. But as you can see, the gap between the stocks Europe, the DAX, and the S&P is at as high a level as we've seen for some time. I've also cautioned not to run away from the U.S. market too aggressively, because I think some of the concerns are overblown, and we'll touch on that in a minute. But European firms have a bit of a challenge. They're dealing with how do they play with China, both for working in China and working with exports from China, and how do they deal with the fact that China's excess capacity in manufacturing will hurt China, or will hurt Germany, Europe's biggest manufacturing country, and how does that play out in the system? And that's leading to firms being more pessimistic about the prospects of doing business with China. And I think about the prospects overall. There is some optimism is very due coming out of the increased spend on defense and increased spend on infrastructure. But when I step back and look at Europe, I worry about what's happened since the great financial crisis. I worked for a German bank in the early 2000s when they were exceptional. They are shelves of what they were in terms of their size and their growth opportunities right now. They've moved from being global organizations to much more European operations and are struggling with the way Europe dealt with the financial crisis for banks versus the way the US recapitalized. So I think that's part of the Achilles heel. I think the other part is the manufacturing sector needs to be reinvigorated and move into new economy stuff away from old economies. So I think those are some of the challenges there. On the positive side, inflation is trending down, and this gives European countries the ability to take advantage of the lower rates that they have in Europe versus the rest of the world to deficit finance like Germany is doing and spend on things that were postponed for way too long. So this is the opportunity. The question again is, can they get the value by pulling together and acting with the scale of a 380 million person market, or do you just get the country's benefit? And I think that's going to be the key issue for Europe. Larry Fink has a very good op-ed in the FT today that's worth reading. It's called "It's Time for a Second Draft of Globalization." And with regards to Europe, he highlights that capital can't fuel growth if it's trapped in bureaucracy. And I think that's one of the deregulation is required in Europe. It's also required in the US. But I think in Europe in particular, for them to break out, they need to do better in that area. But Germany has an opportunity. They just passed Japan as the world's largest creditor nation. Germany has the fiscal space to invest in their own economy in ways that they need to and have postponed for too long, and turn that opportunity that they have from their fiscal responsibility to use it for to grow their economy in a way that they need to going forward, because they have to go through a pretty significant transition. So shifting gears to other parts of the world, I want to touch on India, which is projected to pass Japan for the fourth largest economy in the world. There have been hopes for years that India does what China did years ago. I don't think it's the same story, but it can have this similar outcome if they get it right. It can't have the same story because the economies are operated very differently. But this is a big area of opportunity for capital to flow. I think it's a question of, can they get their act together to harness the benefits of what India has to offer to play big? But again, they're getting caught up in the trade wars, because companies like Apple, who saw the need to move away from China to go to India's market to produce their iPhones, are now being told that that's no good either. They need to be produced here. I think that's a flawed concept in general. I think you should manufacture what you can manufacture well and not manufacture what you can't. I think iPhones fall into that category for the US. I think other high-end manufacturing can be here. I also want to touch on the Gulf, which is an area that I don't know well. I have not researched it much, so I don't speak about it as much on these calls. But Mark and 361 were there 2 months ago. I think, as Mark knows, I like to say, we follow capital flows. Capital always flows to the highest rate of return. You want to get there early. I think the Gulf is the area where capital is flowing to and flowing from. I think they are the prettiest girls at the ball for capital opportunities. And I think that's an area that money will go. I need to do more research on it to talk more about it, because there are challenges and opportunities there that I'm just not aware of. So, but I do think it's an area you want to focus on. But I want to switch gears to the US right now and look at the key points about the US markets. May was a good month, best in 35 years, and the best monthly gain since 2003, driven by the NASDAQ, very positive returns across the board. We've rebounded. I think we're 4% off the highs on the S&P overall. So for all the problems, all the Sturm and Drang that we've gone through, we're still just shy of record levels on most of the indices. Earnings are up strong year over year. Companies are doing well reporting, but I've cautioned people in the last couple months to not run away from the Magnificent Seven because of the size of their balance sheets and the strength of their companies. I don't think the Magnificent Seven is a investable opportunity as a group. I think the companies now are standing on their own and going in divergent ways. This happens when you have big runs like they've had for decade-long periods. New leadership emerges, but look at the rebound of these companies with NVIDIA and Tesla back up. I think that's one side of the equation. On the other side, there is a growing concern about the debt and deficits, and the long end of the market is reflecting that, as you see the bump up in 10 and 30-year bonds in the last month. Gold has been a favorite investment, continues to be. I think it's going to continue to attract capital, particularly with the trade issues and the fact that there is no real alternative to the dollar. So to move away from it, you will incrementally move into gold, Bitcoin, and do currency swaps. And while crude was up for the month, it's down so much over the last 2 years that the benefit to consumers that is flowing through is not insignificant in terms of lowering cost of living for them and for businesses as well. So that's a factor that can't be discounted. So here's the chart of the monthly May performance. You can see how strong it was, and clearly one of the best periods back to the 1990. June has actually not been as good a month. I would not sell in June and go away. I think if you haven't repositioned aggressively, I would only reposition right now in the margins. There's too much uncertainty still with tariffs to be moving around too much. But I think there are a lot of positives out there, and it's easy to lose sight of the positives with the negative headlines that were being thrown out every day and the herky-jerky nature of policy, particularly driven out of Washington. But then we have the wars in the other areas. But this is AI-driven tech spending, adding 1% of GDP in the first quarter. And I would say there are a lot of distortions in the first quarter numbers as people were investing around the tariffs. But 1% of GDP, I would point out that that's what it did for growth in the first quarter. But tech-driven spending is now over 50% of CapEx in the US. It's growing to a much bigger portion in CapEx in China. And the spend there is going to continue to increase demand and increase the needs for a lot of areas of support like memory and other areas, so and energy and the like. So there are a lot of positives. Don't get caught up in all the negative noise, because you have to look through the noise, and you need to either be a great short-term trader or you need to look past and think about the secular themes. Debt deficits and inflation now have taken almost center stage over tariffs, because I think people believe that the initial tariff levels, which China called a joke, will not be seen. They will be higher than we're used to in the past, but I think they believe that the way we've navigated through the pandemic the last couple of years, that we will manage through them. That may be a bit naive, we'd have to see. But I think the real issue is what's going on with borrowing costs, what's going on with debt and deficits, which are becoming much bigger issues and weighing on policymakers' decisions very differently than they have in the past. I've mentioned earlier, I think the US is none and done this year. I don't expect a rate increase from them. I think you've gotten a sense from that from Chair Powell lately. He's certainly not going to be bullied into a rate cut. But what the US does in policy impacts other nations, particularly the emerging economies. So the US not raising aggressively or lowering aggressively, I think, is not a bad thing. I think the issues, what we saw in the how the rest of the world is reacting, is best exemplified in Japan, where they saw massive movements in their interest rates, particularly on the long end of the last month, over a 1% move in their 30-year bond, which I think equates to about a 28% loss in principal for that 1 month period. So not exactly what you buy bonds for. And that's actually changing the policy decisions, such as the Bank of Japan was doing quantitative tightening. Concerns about buyers on the long end of their debt because of some weak auctions lately have them concerned, are they going to have to reverse and continue to be being buyers of their bonds to make sure the supply and demand is in balance. I think the ECB is due to cut rates twice. I think it's a good thing if they cut. I think I'd deal, if I was the ECB, with inflation more than the deflationary pressures that are coming from China's excess capacity being dumped into markets around the world and actually hurting the key businesses that were the drivers of many of the European economies. So I think debt and deficits are a bigger issue. I think the ECB will be moving this month and then down again, maybe in July, most likely in September. I think Japan is in a different spot where they're going to have to adjust their quantitative tightening program, and other countries around the world are going to have to deal with some of the deflationary forces that are coming through from China's excess capacity and some of the inflationary forces coming from the US tariff policy. So that's where the dilemma is. It's a two-sided risk that we have to see how it plays out. But for the markets, the focus is really on debt and deficits, and this is a projection for advanced economies as a percent of GDP. I'm not going to spend much on this because I think the nut of it is we're going to be facing higher long-end debt around the world, particularly in the US, Japan, and other advanced economies. But I think the other message for investors is this period that we've experienced where you had really low interest rates from really going back to 07, but exceptionally low for the last several years, which has created a lot of distortions in our investment strategies. And we have to get back to the sense that we're going to be dealing with 4.5% interest rates on the 10-year for the US. And what does that mean for your investment strategy? What does that mean for your holding periods and your returns? I think are going to be real issues that we're going to be focused on. So just closing, there's money to be made all around the world. I think the Gulf region is, Mark, I think you were very timely in going back there for capital, but I think don't be too quick to run away from the US. Be careful about where you're running to. Focus on the key themes that I think apply in public markets, private markets, and every country in the world. The focus is going to be on required spend, national security, digitalization, electrification, improving productivity, and reindustrializing to deal with the new world economy that we're going into. I think the headwinds are masking four important tailwinds for the US: tax cuts, lower energy prices, deregulation. In the US, we were looking at increased regulatory costs from the last administration of upwards of 6% of GDP. Those are coming down. Reshoring is going to be a big driver of capital flows. We had a period for about 3 years where it slowed down in the latter years of the Biden administration. That's picking up again. So I think these are positives that are not getting the focus. I think overall for equities, inflation is generally trending towards target. It has some risks on the upside, as we talked about. Interest rates are at reasonable levels. They're not going to be the gift that we had of zero interest rates in most economies. But corporate earnings are holding up quite well, but there are big gaps between the haves and have-nots, and I think strong balance sheets are important. I would take the opportunity for volatility to increase quality in portfolios wherever you can. I think productivity improvements can drive up to 2% of GDP growth for the US, but there are big opportunities in other economies as well. And I think from a rate perspective, we're in a wait and see mode, Mark. So I'm going to stop there and open it up for discussions and comments.
Thank you, sir. Adam's quick with his hand up.
Good morning, everyone.
Good
Thank
morning.
you, Stephen. My question's short and simple. Why are we not seeing the impact of the tariffs in the markets yet? I mean, there have been a lot of that hard data. We're not seeing it yet. Is it still too early, or what is the issue?
I think there's a couple factors. I think one is the distortions that were created by capital flows pulled forward demand for this quarter from that you saw the front loading. That actually distorted US GDP. It made it look much worse than it actually was because you had the front loading. I think this quarter you're looking at the Atlanta Fed is looking at a 4.8% GDP now number. So I think there are a lot of distortions. I think what happened coming into the year, you have to remember, the economy was actually doing quite well.
Yeah.
The distortions, the problems came with the tariff uncertainty, and that uncertainty has frozen certain parts of the market from spending. But one of the, I think, underappreciated issues is in the US, spending is high because the boomers are spending and retired, and they're not sitting on their capital. So they are carrying the market in a way that we haven't had that power spending at that level. And I think their net worth is $80 trillion. So that's people who are not working with free time and things to do. They're not buying new homes. They're actually renovating homes. They're traveling. They're doing things like that. So I think that's offset it. I also think the big tech CapEx is really a big driver. And I think there are other required spend that keeps it going. And I think that's what's the driver. It's not the discretionary spend, it's the required spend. Discretionary spend from the wealthy, the boomers, but not more broadly.
Thank you, Stephen.
You're welcome.
So what I want to do, Andy, but before you speak, I'm going to launch a poll. I was going to ask a couple questions, but I actually am pulling from a poll we did 4 years ago. So these are the classic questions. If you all could just, if you don't mind, it's anonymous poll. 5 questions as you keep going with the Q&A. Andy, as he looks at the poll with his glasses. You can look at the poll in a second. What's your question?
Glasses, no glasses. Sorry. Stephen, I'm going to try to be quick. Here's a checklist and pick out anything that doesn't fit. So US spending, a lot of it brought forward by people trying to get ahead of tariffs. So numbers look better than they will. 2, Europe is that although tariffs may settle, the global brand of the United States has been damaged in foreign countries, especially Europe, Canada, etc., even to the point of boycotts, and that although U.S. companies may survive tariffs, that's a long-term proposition, not good for the U.S. Flip side to Europe, which you pointed out, is that deficit spending, monetary easing, at least very good for markets, if not that. And so European markets, I think you pointed out, probably look better than European economies do. But that boycott effect does bring local demand to Europe, improve local demand to Europe as opposed to imports. So the last word would be this $39 trillion of manufacturing infrastructure been built in China in the last 2 decades. If we in the US have a crappy economy, how are we going to fund reshoring of any industrial production? I know it's a lot. I want you to just pick out anything that doesn't fit.
I agree with the pull forward. I agree with the brand being damaged. I don't think the substitution of the US companies is as easy and quick as everyone would think. I think that carries us for a little bit of time. The spend in the European defense area is very difficult to get the scale they need without using US companies in the short term. So I think there's some issues there. I think they are pushing, the federal government is pushing spending to the private sector. And I think the private sector can step up, particularly the big companies. I think it gets to the haves and have-nots. So I think that the US can work through these issues because we do have some very strong tailwinds behind it as well. So I think it's easy to get overly negative. I think it's the pendulum might be swinging too far in negativity for the US.
Glenn, you're up.
Yeah, I was just looking, Stephen, just to get a little commentary around North America more broadly, what's happening. It looks like there's some variance on the cost of debt if you run Canada down through Mexico. And I'm just curious, just sort of a little commentary on the North American side of things.
Yeah, I think that's the hardest part to sort out is how does the US and Mexico and Canada actually resolve themselves? Because the way they should have resolved themselves is to be a trading bloc that benefits each other in enormous ways at the cost of the rest of the world. If you really wanted to have a strong US, you would have a strong North America to do that. I think that we have to see how the policies play out across the board there. I think the growth challenges of Canada are real. Their economy is reflective of what they're strong at, which is energy, materials, and banking, right? Are their biggest areas of strength, and there's challenges in each of those right now. So I think that's a big part of the issues there that lead to the rate differentials and other differentials. Mexico is in a bit of a different spot, and they're caught between the US and China in a much bigger way, with even bigger domestic issues of challenges. So I think if they get their act together, it could be, if we get it right, it could be a really powerful block. But I'm not sure we're going to get it right. And I hope that helps, Glenn.
Yeah, thank you.
Lydia?
I just want to give a little comment on the perception of the US. I'm based in Brussels, by the way, in Europe. So and this, I hope it's a little bit of motivation. So one thing, it's what you're hearing inside, and probably a different thing, it's what it's being perceived outside. Both of them, I think, they are good just to balance out, and you can make your own assessment based on that. But from this perspective, we still hear in all the different, like I go all the time to this conference with like investment, etc., and we still hear the positive part of the US independently of what's happening, but it's just scary. So the two things probably in a motivation wise, like I continue being a little bit more, as you said, not being so negative, but it's because there are so many strong points that they are not yet fulfilled in other regions, like I mean, like, and probably they never will. They never will. But in Europe, for example, we probably you already saw the European Commission sent out a new strategy for startups and scale-ups. That's barely new. We had it at my company announcement officially. The EIC did it. And then, so every region, I think, is positioning in something. And probably this is something that it's in a way missing from the US, but it doesn't mean that it's perceived as bad. They're still strong, and people are still speaking about the same thing, like why startups go to the US. And this is one of the biggest reasons that is still the case. And they still see it in the next probably year. So just a little comment there, but you can do whatever you want.
I think Larry thinks op-ed today in the FT touches on that. You can have money to invest, but you have to have a place for it to be invested in as well. And I think they're sorting through all that right now. And I think that's really a place. Can Europe make it as big a destination for capital as it should be? I think is really an outstanding issue.
Other questions or comments? I'm going to end this poll. We have 40 participants. And I'll give it another 60 seconds. Yes, Jennifer, you have your hand up? The
I
physical.
couldn't find the my Zoom updated. I can't find the buttons. I went analog with my hand raised. So I will say, echo every comment that Lydia just said. We've been in a lot of different rooms recently, and all of that is definitely true. I will say that coming off of Select USA last week, startups are still coming to the US. There's less capital for them. And I think that that's something that we just have to be transparent about in the market. I'm testifying on Thursday, so I was mired deep in prep until about 1 a.m. last night, and going through the numbers of OpenAI and Anthropic taking over 40% of all venture capital out of the market in Q1 is something that we have to reconcile if we want to fund entrepreneurship as a foundational part of the United States economy. That I think gets glossed over. But now we're getting to the point that VC is larger than PE. So we need to kind of flip how we talk about them in terms of holding up the infrastructure of the nation.
Senator, can you tell people where and when you'll be testifying?
Do I have to? I'm testifying in front of the House of Representatives on Thursday for the Small Business Committee on Tax Finance. These are the lovely people that gave us the QSBS tax credit. I'm from a publicly bipartisan family. It's a bipartisan committee, and we're showing our support in not making cuts, because we think, I've done some work in government, and I think anyone who's been to public school can agree that there's room for efficiency in government, but at the same time, not necessarily making cuts the way that it's being presented to this committee at this time.
Very few
You can
people.
tell.
besides
Yep.
me, talked about QSBS. Are you for or against QSBS?
I am massively for it.
Now, do you know about the original QSBS, Section 1244?
I actually read it this weekend.
That hasn't been modernized since 1978. That needs to be modernized and indexed to inflation
Well-
again. I've been lobbying for that for 20 years.
So the core of the comment, that the way that I'm trying to structure my comments on Thursday is that essentially everybody I think on this call has read Lean Startup, and that, you know, we can't just top down implement policy and expect it to last for the next 40 years anymore. And that, you know, our customers as businesses in the US are being very clear about what they need. We need capital access at every stage. And
Yep.
that's going away. So that's what I'll be talking about on Thursday. If anyone has a C-SPAN subscription.
Jennifer, I'm going to reach out to you and I'm going to put a position paper that I wrote 6 years ago about indexing 1244 to inflation. I'm going to put that in the chat box. I'd love for you to download it and read that as well, because it links everything, including the last. It grabs the last time it was indexed to inflation, the actual legislation in the Revenue Act of 1978. So I'm going to put it in the chat box.
Nice.
Sorry.
Oh, you guys can see Olga Loy's testimony here last week on the subject. Michael Hammer.
So first, I want to ask a question of you, Mark,
Oh
and
boy.
that is, when you give us the results of your poll.
Oh, are we ready for the results?
Well, no, hang on. Could
Okay.
you also tell us what the answers looked like from the previous one? that
4
you
years
ran?
ago? Yeah,
Yeah.
I think we saved these polls somewhere in the recesses of the archives.
I just think it would be
Um,
interesting to see. But I wanted
yeah.
to
Can I?
comment on startups because I have a startup and I invest in startups, and I've been investing in startups for quite a long time. And I think one of the issues is everybody says we need more capital invested in startups. But what I've seen over the years is, as people have jumped into the investing in the startup space, there has been a lack of due diligence. There's been this exuberance. Who in their right mind would have thought that $500 million would have been put into mobile pizza ovens? I mean, some of the stuff that's been getting investor money has been absolutely ridiculous. And when we look at some of the current investments in AI and the valuations, one, not all of these companies are going to survive. And B, at the valuations that you see, how do the investors get their money back? I mean, so I'm a little bit more skeptical. I think that, yes, we need good policies on startup investing, but I'm not sure that it's just a lack of capital.
Well, to your point, capital's not going back to traditional venture investors right now because of the lockup in the M&A and IPO market. So what you're saying is exactly what's happening, is that, you know, you're a great example of a traditional venture investor, Michael, is that you seem to know something about tech. You're in startups, you recycle that capital back into the space, which is the traditional LP relationship as well, but they haven't gotten capital back. So you're seeing this double-edged sword of, there is actually less money going into startups than there has been in the past 5 years. On top of that, you're seeing a consolidation into larger VC firms. And so it's leaving less for these smaller things. That's how you end up with billion-dollar pizza ovens.
Well, but I've also stopped investing in funds, and I do direct investments because I'm not a fan of the 2 and 20 model. I think I've said this before in previous sessions here, because it rewards people for subpar performance. If somebody gave me a real 30% return per year, I'd be like, hey, take a 30% carry. I don't care. It's not just a function of LPs not getting money back because of locked up M&A. There's a whole raft of issues. And a lot of the people that I see investing in funds these days are relatively newcomers to investing in startups.
Michael,
Yeah,
you know, sometimes you take issue with Stephen Burke, right? I'm going to take issue with you.
okay.
You talk about people who are new. Uh, uh, I find the people who are new are the ones investing in shiny objects of these direct deals that are being shown to them. And I
That's
find, sorry,
that's true too, but that's a different issue.
okay. So I I was with the family office for 10 years. That's dog years, that's 70, right? And in that time, we invested into funds in the end. And you're right. I think the private equity model, the AUM game model, is an issue, and what Senator talked about is an issue. But I think if you have funds with an edge, like you have an edge in cybersecurity, right? Because of you have domain expertise. I doubt you're going to be investing in pizza ovens. Sounds like it lately, but you're going to be in. You should. You probably could know more than any private equity or VC fund in your lane, right? But when you get out of your lane, but should you be investing? Sorry. To have a diversified portfolio. Okay, this is a longer discussion. And we should talk about it again, Stephen Burke. This poll sort of goes to it. Let me just, if I could, and hold your fire, everybody. Let's just see what the poll is telling us. So, and I will find, yeah, you had a good question, Michael. We'll have to find the results. And we actually have 17 surveys. So, Bill Deichler, we could look at the survey results because they're not unlike this. So we got a little bit of Europe. We have a lot of East Coast US on this call. Single families, you've been punching at funds. There's some fund managers on this call, C-suites, and I don't know who the others are. It's a big category. Asset classes you plan to invest in. Well, public equities, apart from hedge funds, 17, venture 17, sort of equal with real estate. And then directs, VC directs, VC only funds. And then asset classes that you think will perform best, public equity versus private equity, and then credit. Well, I mean, credit can't perform as it should perform to its risk reward. Do we have crypto on here? I don't know if it was so old that we didn't have it. No, I don't know. And then to the extent that you invest in public equities, where are you? Active your own book, or active versus hedge fund versus bearish. So, in emerging markets, geez, I haven't seen that big of an interest in emerging markets in a while. No one's long short. Interesting. Any thoughts on those results?
I'm interested for the people in the emerging markets, what the thesis is, given they've been in the doldrums for such a long time.
I mean, the fact that they've underperformed year after year?
Yes. Is it just playing the cycle?
Who wants to make the case for emerging markets? Anyone?
It's Anthony Gordon. Hello.
Yes, Anthony.
So just sorry, I was distracted for something going on here. Are we saying that there's no interest in emerging markets, and why?
11 people. Actually, the largest category showed interest in emerging markets, but we've not seen it. We haven't seen that pan out well for everybody year after year.
Okay. Well, I would disagree. I think if it hasn't panned out well, are we talking about cross asset or specifically in public equities or all asset classes in emerging markets?
In public equities or hedge funds.
It's an absolute misnomer. It's a lie. It's an untruth. And it's because people aren't doing the work. Passive ETF indexing to begin with, you're disadvantaged. Emerging markets, 1, 3, 5, 10, 12 years. How about Mercado Libre? How about Taiwan Semiconductor? How do you define emerging markets? Is it where the company is based within the regionality, where it's domiciled and registered? Is it where their revenue comes from? Is it, what is it? Okay. But if you take any and all of that into account, the stunning companies in emerging markets have done exceptionally well because they're great companies. So let's just take some examples because it's all about data, numbers, and proof is in the pudding. Mercado Libre, Taiwan Semiconductor, Tencent, which is connected to Naspers, which is connected to Process. Process, most of their assets are in emerging markets. It trades in Europe on the Dutch exchange, and Naspers trades on Johannesburg and on the NYSE. But let's keep going because that's not enough, right? So there are, if you look at India, there's an index, and then the Indian banks, which used to be the large mega ones, which had the best 20, 15, 10-year returns, and now it's the smaller banks. Look at the South African bank Capitec, which is up no less than, I think it's 2,500 times since it IPO. No, that's not a typo. So look up Capitec trading in South Africa. Jerry Fourie, CEO, who's about to retire out of Stellenbosch. They were seeded by a company.
Can I do this?
What?
Can I do this?
Oh, sorry. I thought you said, can you do this? And I thought you said Capitec. Get the pun. Okay. Sorry. Go ahead.
I get the pun. I guess I picked a fight with two people today. I'm not really sure I'm against emerging market. I'm just, I think we should define it to Lubna's your point.
Okay.
Let's
please,
do it.
let's get me started. Wait, Mark, you have to give me this. You have to give me this. I raise my national flag. I am an American and a South African and a European. But which gold mining stocks have performed the best? With no question. I'm not talking about criminals or Canadian explorers. I'm talking about real miners. So Harmony, Goldfields, AngloGold Ashanti, where these stocks, where these companies domiciled, where are the mines? They mine in South Africa. South African gold mining stocks have much higher beta than any gold stocks. Look at the worst days in global equity markets.
All right, here's what we're going to do, Anthony.
The gold South African stocks lead every time.
We are going to give you a stage, and we'll give even Michael you a stage. We're going to talk about funds versus direct, and we're going to talk about emerging markets. We're going to have two different deep dives, and we get into it properly. And get ready to flex your muscles on both. And we're going to bring in the Oxford debate style that we did in Riyadh, if you remember that, Lydia. We want two people for and two people against, and we'll have an audience decision.
Yeah.
All right. Is that fair? Yes.
I'm ready to do it anywhere, anytime, and I'm ready to do it right now, unrehearsed.
I know you are.
And the data's in my head. And that's
I know you are. I know
no preparation. Let's go.
I need to set it up. That's all. Okay.
So I'm not against funds. I'm against the 2 and 20 model, and I'm not seeing alternative models.
Let me ask you this.
I got one. I got IP out of Utah that does no fees up front, that does a 60-40 split on the back. So Michael, reach out to me after the call and we're happy to have a chat with you about that. We're open right now and have about 600 left in the fund before fund 2 starts.
On that 40% carry, do they have a threshold?
Yes, and a waterfall. Yep.
And a waterfall. Okay.
Okay, we should talk, Erica. But the other issue is I am so overweight in startups right now that I'm actually holding back from investing.
So the conversation really didn't merit this time this morning.
well, is it
no,
Eric,
because I've got money on the sidelines.
Don't we all? Welcome to investing in startups. 40-year road for me.
Michael, you got to make it out to the West Coast, and we'll put the gloves on. Andy Fish.
Michael, it's not 1999, but it is a little bit. So the biggest difference is, can't speak to your pizza oven specifically. There was a few years ago where startups were getting way too much money. There is no question that people are not doing the work, whether it's funds or directs. It's simply that in venture, this is the first time, I've been doing this 40 years, that my first VC deal in 94. Nothing went wrong in startups or anything else for a decade. So the people that are not doing the hard work, it's because they haven't lost any money ever. because they're only 35 years old and nothing went wrong for 10 years. But it's not 1999. There's a lot of, you're right about AI, but it's like the internet. There's going to be a ton of losers and a few winners, but the winners are real. Webvan, you're talking about pizza ovens. Webvan in 1999. There just aren't very many of those around that I see, at least. But there's a lot of new venture funds that don't know how to do down rounds and rights offerings and all this stuff. So it's half yes and kind of half no. The 2 and 20 model, by the way, is kind of half dead. I'm seeing clawbacks. I'm seeing 1 in 20s, 1 in 15s, all kinds of stuff. The big guys, yeah, they can still raise billions at 2 and 20, but you can also a lot of funds you can negotiate fees now. So a little bit of everything.
You got to start somewhere for that negotiation. All right, we've covered some interesting ground. What else? What
I
other
think
deep
we have the wrong picture of Africa in the Western world. And if you have a deeper look to emerging markets in Africa, like Nairobi, for example, there is a huge community of new startups, and the bottom-up approach does work much better than the wrong giving top-down, because there are so many hands open in the top-down approach. But Africa is completely different if you have a detailed look. And there is a lot of resilience. They know how to solve real problems. And if you solve real problems, you can be successful. And I'm working, for example, with an Future Africa, a fund in Nairobi. One of the founders is a serial entrepreneur, and he was a founder of M-Pesa, which is one of the unicorns in Africa. And there are many, many others.
Money
But it is
transfer, the
important.
first peer-to-peer money transfer.
I'm sorry?
I think it's just important to explain what M-Pesa is, that they were the first peer-to-peer money transfer before anyone else, before fintech.
Yep. Yep. Yeah, and there are a lot of others. I was working with a company who is building a full banking system for SACCOs. SACCOs are the banks owned by their members only, and they are growing brilliantly. Only raised 4 million in seeds and another 3 or 4 million on top of this. They don't need a Series A because they are doing quite well.
What percent of your portfolio would you put into Africa, Gunter?
I'm working with startups and venture funds in Africa. One, for example, is building electro motorbikes in Ghana. It's led by a female, and they raised 8 million in Series A last year. Now they are doing a Series B round. And they are a spin-off from BMW in Germany, but they are working on the ground with local knowledge, and they are doing quite well. A similar company in Kenya, and many others in different areas, different fields. Or have a look to Africa Eats. It's a brilliant development
Gunter,
of
do you know
a company. Sorry.
Do you know Launch Africa, the fund?
Yes, of course. I have a long list of about 350 well-researched funds that have done at least 5 investments in startups in Africa, and another 1,000 who have done at least 1 investment. Not all are successful, of course. You need to adapt everything to the local culture, because Africa is a continent with 54 countries and many different cultures. And without deep knowledge of the culture and trust, you never can be successful.
Gunter, as a
Trust is
European,
key.
what % of your portfolio would you invest in Africa out of your total portfolio?
I cannot answer this for
No,
everybody,
I'm just
but
curious, is it like 5%?
at the moment, I
10%?
would say the majority is in Europe, and maybe 15% in Africa and the rest in North America.
Thank you.
But it can grow.
Can I just say that I'm extremely cautious about Africa? I was born in South Africa. I went to school in Grahamstown. If you look back at the McKinsey mania, which was joined with many other firms with that kind of stature, they were all keen and very bullish on Africa until they weren't. And now they've recircled, and I don't have the data in front of me, but the growth is expected to be immense. Having said that, the best and the finest, if you look at the law and legal standards, separate and apart from the corruption that we know about and have seen in the country where I'm from, is of a very high standard, and publicly traded companies to the likes of a General Mills, not to be confused with the one here, have been, I don't want to use the R word, but they've been torn apart by going deeper into Africa. And I'm not going to mention which countries, but you can imagine it has not worked out. The fraud, corruption, and everything around it is a repeative, mantric process, which may have different adjectives or definitions locally, but as Anglo-Saxon or whatever, US law, whatever kind of law we want to apply, it doesn't seem to apply en masse to all inclusively those 54 countries. And so it is extremely treacherous to get involved. I would say that M-Pesa was a outstanding situation. And if you look at the problem with M-Pesa and the relations that surrounded that, Safaricom and Vodacom, the liquidity is a hindrance. So you can't go and buy M-Pesa stock in Nairobi with any kind of liquidity of any nature from then and even today. So that doesn't work.
So Anthony, maybe we've just created the third deep dive, the case for and against Africa, and as it's been said, it's 54 countries. So there's got to be something.
Exactly.
There's got to be some. I used to call. I mean, of all places, I was 8 years in Russia, right? I was making a case for investing in Russia. I remember being with Blackstone or Intel, and I was like, well, like a series of factors would have to, all confluence to be against Russia. And they came. But I used to call Russia a partly cloudy country to stay away from the licenses. But Africa has its places for sure, fintech and the rest. So we're Gunter, you will form your panel, and Anthony will form his. So we have our third pro-con deep dive. So we've got funds or directs, Africa, and emerging markets, although it's sort of a spinoff of emerging markets.
I just want to
Andrew Randak. One second, Andrew, you're gonna make the case for LATAM, Andrew?
No, God, no, absolutely not. Stay away. You can marry it and you can have kids with Latins, but you can't actually invest there.
I see. Well, that's
one of the
person's
things,
opinion.
having spent 30 years investing in an emerging market, in many emerging markets in Latin America in particular, is they're awesome companies. Anthony's right. They're incredible companies, amazing management teams. These guys know how to run balance sheets, income statements, factories, whatever, you name it. The know-how, the expertise, the desire, the animal spirits are there. What I have most trouble with in Latin America, and this may apply to Africa, is when you want to sell. And if you have a large position, you're your buyers are very limited. You have to sell, and therefore you end up having to take a discount, having to absorb a discount. And if you have a small position, well, it's hard to sell too, because who's going to buy a small position in, you know, a minority stake in a private company? And the public markets, I'm guessing Africa isn't as developed as Latin America, but in Latin America, the going to the public markets for exits is extremely difficult and time consuming, and very few people do it. So I would love to learn more about exits in those markets and how people do it. I think that would be fascinating.
Fair enough. Well, I'd like to see, that's been the problem in the United States, exits. It's a global problem.
I just wanted to mention, Anthony mentioned that one of the big consulting companies invested a long time and money in Africa, but they typically work in a top-down approach. And that is exactly what I told you earlier. The bottom-up approach is possible because then you can avoid a lot of corruption over there. And there are huge amounts of young people who are well educated and can build companies. And if you combine local knowledge with AI and whatever is coming on technology, you can do brilliant things. So think about Africa is very complex, and you have to invest in local knowledge and local partnerships. Otherwise, it cannot work.
I will say I agree with what you guys are saying. It's a very hard environment. I've lived there for 10 years, still a resident in South Africa, worked in Kenya. The Silicon Savannah in Kenya is amazing. What I will say, when I've looked at consulting firms, being part of a consulting firm, working there, often the consulting firms would even advise many of the startup founders to stop doing some of the community projects that they did that were very much to lift up their community, especially in Kenya, right? So Kenya, at the time when I was there, there was like, you know, 800,000 people applying for 60,000 jobs. So everyone was an entrepreneur and everybody was in an investec, like in a hub trying to do something. But often the consultants would come in and try to minimize some of their projects, when most of the times their projects were also about empowering their community. And there could be a lot more long-term profit in that, but the consulting firms would just tell them to cut it.
I just want to punctuate something that I think everyone will remember, because otherwise it's just, you know, I speak, but I don't think it's really going to sink in. So Harmony HMY trading in New York is a large South African mine. We all know gold's gone up and it's had a great run and so on and so on. But Harmony just a year and a half ago or so was about $3. It's trading at about 15. And who's the largest shareholder of Harmony in the world? It's Lingota. And what is Lingota? Lingota is roughly a $7.2 billion asset manager, and it's owned by Exor, EXOR. And Exor is the investment arm of the Agnelli family. And the Agnelli family, as you know, is related to Ferrari. So this is a collective of smart, smart people based out of London, and they own about 8% of Harmony. So, you know, I don't think that's insignificant. And, you know, what I say is not really important, and you probably don't give a darn, but the fact that Lingota own 8% of Harmony just punctuates, in my opinion, what I'm saying. It's not a recommendation to buy or sell Harmony, or that it's viable. It's just a fact. I happen to like Harmony and I do happen to own it, but that's besides the point. Just one last thing on Africa. My experience has been two-sided, Morocco and South Africa. And that's principally because of the rule of law and the exercising of law upon others, not necessarily the government, which seems to stand alone and isolated and do whatever they want when they want. But for everyone else that operates within their jurisdiction, the benchmark from an accounting and a legal basis is extremely high. And again, don't take my word for it. Look at the ratings, and you'll see.
We'll come back to Africa on a proper deep dive. Any last
Yeah, question from
Com-
Anthony. Which Harmony would you look at? It's listed in a lot of different markets. Do you own it in South Africa? Do you own it in New York?
I would look at Harmony in New York, HMY in New York. South Africa, the South African rand is one of the most vicious, volatile currencies in the world. And you can hedge it. Obviously, that's predicated on their risk-free. Well, it's not risk-free, but their overnight interest rate, which is currently roughly about 7%. So it's very expensive to hedge the rand, dollar neutral. So that means that if you owned it in Johannesburg, you would be very unwise not to hedge it, and that would cost you about, 7, 8, 9% to hedge it dollar neutral to have no volatility. The Johannesburg Stock Exchange is extremely liquid, extremely honorable, and very reliable. There's no risk there, in my opinion. But I would own it in dollars, and you can also buy options on it in dollars on the NYSE.
And
Sorry.
Andrew, reach out to Anthony if you want these nuances.
I will. One of our clients has tasked us with looking into a lot of this stuff. So, as well as uranium, Anthony. I don't know if you have any experience in that in South Africa.
I know a lot about uranium.
Reach out to him. When
I'll
you're
do
in the
that.
city.
Thank you.
Anyone else? I'm in the car. I've got
Mark,
a meeting.
can I help, kind of add some positive light to Africa?
Okay.
You know that I'm part of the G20 B20 thing for 11 years. And besides the corruption with government, corruption through a whole bunch of NPOs, nonprofits out there, and one of my members here actually became a student of mine, and he's a Google leader. And I've learned from him and through my research that this nonprofit called Opportunity International, opportunity.org, is really standout global NPO where they very efficiently and smartly help alleviate poverty by creating and uplifting entrepreneurs, kind of micro, small businesses and all that. By it's sort of like a derivative approach where the funding is actually kind of only tens of millions, but they're able to create like over $1 billion in value. It's pretty amazing. So there are things like that that's happening that's sort of pretty positive. Of course, building a business, investing is about building value and managing risk. We all are very astute about that. But take a look, opportunity.org. It's pretty encouraging.
Okay. As I parallel park running a Zoom. Sure.
Be careful, Mark.
Yeah, drive careful. And the last comment, it may be helpful if you not only want to nurture your pocket, but also want to nurture your heart and invest in impact topics. If you can improve people, planet, and profit, supporting the triple bottom line, it may be much better. Thank you very much.
Yeah.
And have a good time. Thank you and bye-bye.
Thanks, Gunter.
Thanks.
All right. Anyone else with a comment or question?
So
Mark,
I have a,
go ahead. Yeah, Michael.
oh, so slightly off topic, but interesting. I don't know if anybody else saw that EOG is acquiring Encino, which will cement EOG's dominant position in the Utica. And part of what's going on there is EOG has been drilling deeper down to the Trenton Black River play, which is really more of a pool oil play. So I expect to see very interesting stuff happening in the not too distant future.
Who owns Encino? Was it First Reserve?
The main owner was Canadian Pension Fund. I can't think of the name.
Okay.
And I'm kind of curious because of how they put together their holdings. The acquisition was 5 point something billion. So I'm just wondering how much, how profitable was it for them? I think it was pretty profitable. But a good exit for them.
Yeah. Thank you. Anyone else?
Mark, I might have missed something. I had to hop earlier mid-call to chat with the founder. If you have time later today for a 5-minute call, I'll give you a ring.
We'll do that.
Sounds
Well,
good.
I'm just. Hi,
Thanks,
I'm
Mark.
meeting with Reg. I'm finishing up my Zoom. Can I put you on Zoom? You can see, give me, this is Reg Afaf from Dubai. All right, well, that's probably a cue that we should end.
Enjoy your
I
lunch.
will thank everybody. Thank you, Stevens.
you. Thanks,
Thank
Mark.
everyone for your questions,
Mark.
comments.
Bye-bye.
We'll speak soon.
Yeah.
Come join us in California and Washington.